Today I'll be showing you a cheap option strategy for about under $20 that can double and triple your profits within a week from now. So when I'm recording this is on August 14th, so we're going to set this expiration date on August 20th. And you're going to want to do this on a stock that trades pretty sideways, doesn't move very much. So AT&T is always one that's going to trade pretty sideways. If you look at this price right here, this price change and this percent change, you'll see it doesn't move very much at all. I'm not even sure if it hits $1. Yeah, it doesn't. We'll go a week. Yeah, it never hits $1 difference. So it trades, besides this drop right here, it's still pretty stagnant. So this AT&T is a great one for this example. I still do your research before copying this exact trade. This one is just an example. But we're going to use AT&T for this example. So what you're going to do is you're going to want to sell a call at the price point that we think AT&T will be at by August 20th. And like I said, it is August 16th right now, and AT&T trades pretty much sideways. So for this example, I'm just going to say that AT&T is going to be around the $28 price. So we're going to actually sell two calls right here, but we can only click it once. So I'll show you how to change that in a second. And then you're going to want to buy two calls again, and these are going to be, one is above this $28 price that we chose, and one is going to be below the $20 price, and they're going to want to be equidistant from each other. So that means if I buy one at this $29 strike price, you see that's a gap of 2, 1, 2, and that means that with the other one we buy under this $28 price has to be a gap of 2 again. So 1, 2, it'd be at this 27 point, and you can see that as a 1 buffer between the two. Let's say I bought this one right here, then that means that the one above has to be one gap, if that makes any sense. And so for this example, let's say, let's just keep it simple and say it's a one gap below and a one gap above. So we're going to do it that way. And you'll see this is not what it's supposed to look like, so because we have to sell two calls. So you come over here, click this drop down, click on custom, and you're going to go to the ones that we sold, make sure it says the one you sold. You're going to switch that to 2. So now you're going to see this little pyramid looking thing. And so this is what you want to see. So between the 27.68 and the 28.32 mark, we're in the green. And that's pretty realistic because, like I showed you, AT&T moves literally just dimes and quarters over weeks, over a week span. So it's pretty realistic that within 6 days from now that AT&T will be sitting between here. And then our max loss is $17, and that's because, it's just a little different, but it would be the $18 that we spent. So you're going to spend $18 to put this in place. It's 18 cents times 100 because options control 100 shares. So we're going to spend $18 to get into this, and let's say it goes perfectly. It's sitting right at the $28 price that we chose. We're going to make $33, and we spent 18. So you're going to get the 18 back and then 33 more. So your max profit is 33. Let's say, and then this is where you break zeros, 27.67 and then 28.33. And then after that, you're in the red area, and the max you can lose is $17. You can also do this with puts. So this is called the long call butterfly spread. I recommend that you do some more research into this before putting this in place, and it is options, obviously. So I'd recommend you research all the risks to options before you put these types of things in place, because there are risks to them if you do them improperly. So you can do it with puts too. It's a little different. So for this example, I'll just do the exact same thing I just set up. So there's that. This one will be $20 to put, or $19 to put in place, and you'll make 30. So it's a little different. Sometimes the puts are better than the calls, and sometimes the calls are better than the puts. And obviously in this case, the calls are the better option here. So I'll set this up one more time. Let's say I want to do a gap of 2 just for the example. I'll show you with the gap of 2, and then go to custom and go back to the one that we sold. Make sure that says 2. There we go. So you can see when you do it with a bigger spread, you give yourself more room for profit. I mean, it's really not worth it. It's like 20 cents more space. And if you're wrong, then you lose $61 and you can only gain 39. So I would definitely consider having them closer together so that loss is less and your profit is almost the same. But this is called a long call butterfly spread. And I would recommend doing all your research on options trading, like I said, because there are some risks to it. But if you do have any questions, make sure to comment them down below, and I'll be sure to answer them all. And thank you for watching. Have a great day.